I'm Scott McIntyre, and this is Greg Warner, and we're co-heads of the Investment Management Division of HilltopSecurities Asset Management. And Greg, the Fed cut rates in September, and in October, and in December, and then they paused in January. And my question for you, which I think is a question that a lot of our clients are wondering, is when does the Fed resume, assuming that resuming means easing and not a rate hike, which I think we agree on. How many eases will there be next year, and what factors are Fed members considering to make any move at all?
So just your basic predict the future question.
Yeah, no, it's a predict the future question, absolutely.
Yeah, so first and foremost, I think you talk about the factors, and obviously the factors are always employment and inflation.
Right.
And in this case, employment right now seems to be relatively stable, and there's enough question marks around employment that I think we kind of have to set that one aside. I think the Fed is primarily focused on inflation, entirely on inflation right now. Their task is to get inflation back to their 2% target. Their credibility depends on it. I think that's why they paused in the first place. They looked at CPI and PC indicators coming out of the summer and early fall that were still well above their target and not moving lower at that time, stuck kind of between a 2.5% and a 2.8% range when they want it to be 2%. The Fed is looking for inflation to move lower, and it's going to take that before they resume their rate cutting cycle. Now, the question is, will inflation move lower here in the next few months? And I think it will. CPI actually did move lower in November, December, and January. In fact, it's below 2.4% through the end of January. PCE data is stale and lagging. We haven't gotten the latest release because of the government shutdown, and so that data is a little bit behind. We've been following a private sector indicator called Truflation, and it pulls in price data from over 1 million data points off the web and calculates a daily index. And when you look at that on a year-over-year basis, it's now less than 1%. Truflation tends to lead big moves in CPI and PCE. And then since it's moved sharply lower since December, I anticipate that we'll see PCE and CPI following. And that will allow the Fed to resume its rate cuts. And I think it's probably going to be at least June and probably more like July before we get to that point. In terms of how many, good question. 2, 3, where do you fall in that spectrum?
Well, let me add to your thoughts on inflation retreating. So I feel like not only do we look at truflation, but you look at shelter costs associated with CPI, which makes up about 36% of the overall index. And shelter costs have been falling quite a bit over the last 4 years, and it looks like they're going to continue to fall. So that's a great big weight down on overall inflation. You also have the year-over-year factor. So in essence, what's happening is that we're just naturally going to fall in terms of inflation because of where we were a year ago. A lot of reasons to expect that the Fed's 2% target is attainable. So you get to the other point, and the other mandate, which we dismissed earlier, is employment. And the actual reason that the Fed would be inclined to cut rates is because they're looking at the labor market. And the labor market is very, very noisy. There's no question about that. We just had a crazy employment report from the BLS for January, where there were 130,000 jobs that were created, payroll ads in January, which was about twice the expectation. But at the same time, there was a great big revision to the previous year.
The annual benchmark revisions.
Exactly. So when all's said and done, for 2025, there was an average of 15,000 jobs created every month. So the question is the 130,000 good? It is in relation to what we were looking at last year, but overall the labor market is weak. And that's why the Fed would decide to cut.
Yeah, and by the way, you mentioned only 180-something thousand jobs created last year on a $158 million employee base. That's barely any growth at all, 0.2% growth in payrolls for 2025.
And all of those jobs came from basically the healthcare sector, for all intents and purposes.
And then we have the AI story and productivity growth that's hitting us as
well.
Right.
There are so many factors to consider here. My thought is that the Fed is under a tremendous amount of pressure to cut because job growth looks so anemic, and because we're just a couple months removed from the unemployment rate being 4.6%, which was the highest it had been in 4 years. The Fed would cut if the Fed has the opportunity to cut, and inflation will give them the ability to be able to do that.
The flip side of that, of course, though, is the unemployment rate as of the end of January is 4.3%, which is historically still very, very low. In fact, if you go back to 1970, there's only been 3 other occasions where we had an unemployment rate below 4%. So unemployment's hanging in there. Some questions about how it's measured, perhaps.
Well, and then you get to economic growth in general. So the last 3 quarters have been stronger than expected. And first quarter should be solid for a lot of different reasons that we don't have time to get into. And typically, whenever you have an economy that is doing well, it produces jobs. And this economy has not produced jobs. And a question that I would have is, if the Fed does cut 2 or 3 times, does that actually result in more jobs? And I guess that's a big question that we're going to have to see how it unfolds, like everything else.
And with net immigration essentially flat or zero now, how many more jobs a month do we need? You know, we only need to add maybe 50,000 jobs per month instead of adding 150 or 200,000 jobs per month.
Productivity is booming. A lot of it has to do with AI. So as a result of that, the number of jobs that need to be added to payrolls are significantly less. I know there's so much noise in all of this, and there's so many different tangents, but we're a day away from the expectation that the Supreme Court is going to rule on the constitutionality of the reciprocal tariffs. And obviously, if the Supreme Court were to decide that those were not constitutional, then the idea that we wouldn't have tariffs on U.S. corporations going forward, at least for some period of time, would suggest that inflation would be even lower. So in answer to your question, and I have a tendency to get long-winded, but in answer to your question, I would expect that the Fed would cut. And again, this is more a guess-expectation than an expectation, but I think the Fed will cut at the June meeting, in the middle of June, and at the end of July. Then we're approaching an election, so I would think that the Fed would probably want to pack it in at some point and retreat to the sidelines. 2 to 3 rate cuts, not necessarily because they need to stimulate the economy, but 2 to 3 rate cuts, in my mind, because there's so much pressure to do that. So the president is screaming, I want the overnight rate at 1%. He's got a new Fed chair, which I'm assuming Warsh will be the new Fed chair and the new FOMC chair. And I just think that pressure on all of those other Fed officials will push them to probably easing more than they would normally. So I think that's sort of my base case, is that there will be so much pressure that will result in more rate cuts than we necessarily need, which may ultimately mean that inflation in the future is higher.
It will take lower inflation to get those rate cuts, though. And I agree, I think there's a lot of pressure on the Fed to ease, but I'm not sure it means all that much. So it'll be interesting to see what Kevin Warsh brings as a new chair of the FOMC, and Powell steps outside.
And will Powell step outside? I guess that's another question, another tangent, another wild card to consider, is that Powell has the option of staying on until January of 2028 as a Fed governor, and he will get a vote, and he will be extremely influential. I mean, we'll have a new Fed chair, but we'll also have the old Fed chair if he decides to stay on. And who the committee decides to listen to is again, something that we're going to have to see whenever we see.
Okay, so let's boil it back down and wrap it up. We both think the Fed resumes rate cuts by July. I'm thinking July, you're thinking June. And then probably 2 or 3, and then they go back to the sidelines.
September will be the 3rd, and then we're fast approaching the election, and in my opinion, the Fed can retreat. Plus, if the Fed cuts twice, the lower band is 3%. That feels okay in my mind. The lower band at one point was 5.25%. So that's a significant amount of easing. And the 3 eases that they have made in September and October and December haven't made their way through the economy yet.
True.
So,
and their professed neutral rate is 3%, which makes 3% a natural level for them to want to get to.
I think we're in agreement. As of today, the one thing, another thing to keep in mind is that things change very, very rapidly. And in 2026, I expect that it's going to be even faster than it has in the years before.
I don't think we get to 3% as quickly as you do. I think the Fed is more cautious in their approach. I think we start seeing rate cuts come July, but maybe then they skip and they do every other meeting.
I think the Fed should be cautious. I don't think the Fed will be cautious. So that's
right.
where I'm going to end it.
Well, let's leave it there. Thank you all.
Okay. Thank you.